the government can confiscate through hyperdeflation or bail-ins, or just taking everything that you think that you own, or it can hyperinflate and destroy the dollar so that you can't purchase anything with it, or it can just tax you to death and take everything that you earn. And that's another way of doing it, but it's all the same thing. It's just theft.
In a world marked by economic extremes, Rafi Farber offers a vital perspective on the dynamics of hyperinflation and hyperdeflation. He sheds light on why gold and silver emerge as crucial anchors in today's unpredictable financial terrain. Join us as we dive into the core of this economic turbulence, examining how these precious metals provide stability and resilience in the midst of unprecedented monetary challenges. This is a journey that demands your attention, one that could reshape your understanding of preserving wealth in times of uncertainty. Let's tune in to Rafi Farber.
Hey guys, Rafi here from the Endgame Investor. Gold has been falling after breaking through a triple top. It is driving the technical traders a bit nutty. I've been asked to opine. I got a really good question today and I wanted to share it with all of you and my answer. And I'm going to go through some charts to show you that hyperinflation and hyperdeflation are really two sides of the same coin. It doesn't matter if we end in hyperinflation with gold at $35,000 an ounce and silver at $2,330 at a 15-to-1 ratio, or if we end up in a hyperdeflationary scenario where banks basically steal all your deposits and brokerages steal all your stocks and all your bonds and anything that you own that's paper assets, and gold goes down to $35 an ounce and silver is at $2.33 at a 15-to-1 ratio. It doesn't make a damn bit of difference, and I will show you how and why, showing what happened in 2020 to purchasing power. What matters is purchasing power, how much you can get with your physical stacks. The only difference between hyperinflation and hyperdeflation is that in hyperinflation, your stocks would still have nominal value and your brokerage wouldn't thieve and steal all of your paper assets, and gold miners would go through the roof. Whereas in hyperdeflation, it could possibly be that your brokerage will steal even your mining shares. And in order to protect yourself against that, you have to stack physical gold in a place that the government cannot find. I personally think that hyperinflation is much more likely than hyperdeflation, because hyperdeflation means that all of the banks die. And no, the Fed will not be able to revive them with a central bank digital currency, because that's just another dollar derivative, and that will be confiscated as well. Even in the event of hyperinflation, which I think is much more likely, let's say gold to $35,000 an ounce and silver to $2,330 in a 15-to-1 ratio, which that ratio itself is the hyperinflationary endgame bell ring at the top. It's the ratio that matters because it shows that silver has returned to its monetary ratio, which means is that the gold derivative of the dollar is dead and people have moved to silver for monetary transactions. Even in the event of hyperinflation, at the end, the dollar will probably be redefined from $35,000 an ounce to $35 an ounce back to the 1971 levels, and anyone who has dollars in his bank account or brokerage or anything dollar denominated loses 999 out of 1,000 of what he thought he had nominally. So it's the same thing. It all ends with bail-ins. What people have to understand is that the method of confiscation makes very little to no difference. The government can confiscate through hyperdeflation or bail-ins, or just taking everything that you think that you own, or it can hyperinflate and destroy the dollar so that you can't purchase anything with it, or it can just tax you to death and take everything that you earn. And that's another way of doing it, but it's all the same thing. It's just theft. Now, if we reason out what would happen in a hyperdeflation where the government, like Argentina did in 2001, just simply takes everything you have, including your brokerage and your bank account and whatever else you have that's dollars denominated. If they do that, what happens? Well, everyone who thought they had purchasing power suddenly have no purchasing power. So what happens to the prices of consumer goods and services and real estate and farmland and everything else? Well, the dollar price of that collapses because suddenly nobody has any damn dollars. So what do people have? Well, the stackers who have buried gold and silver in their backyard or wherever on their topographical maps that they can locate it, they have real money that they can access. And so because gold is the money and the dollar is just a gold and silver derivative, everything becomes exchangeable for gold and silver at radically low prices. Gold in 2020 crash fell 14.86% from the highs. And I have that highlighted on this chart. The high, the post-bear market high, was 1704 and 30 cents. And the low on March 16th, the next week, was $1,450. But that was less than a 15% drop. What was happening to every other commodity in the world in dollar terms? Well, look at the CRB index just in those 2 weeks. And this isn't even counting the entire breadth of the fall from, what is this, 187 on the CRB to 101.48 at the lows. That is almost a 50% cut. Just in those 2 weeks, we saw a 33% fall in the CRB, meaning collective commodities. So would you rather have a 14.86% fall in gold or a 33% fall in the rest of commodities? And that means functionally that gold doubles its purchasing power. And you can see that in 2 weeks, it doubles its purchasing power. And you can see that here in the gold to CRB index ratio. How much CRB units, how much commodity units can gold purchase you? And going back all the way to 1991 here, it was pretty stable until we get to the 2008 financial crisis. And then the real purchasing power of gold just rockets up from about 2 or 1.5 or whatever that number is to about 5. It more than doubles. But look what happened here from 8 to 16, I think it is the high here. So it doubles again in just 2 weeks. It was insane. That means that gold's purchasing power skyrockets during these times. Obviously, this was only 2 weeks, so the prices didn't have time to filter down into the consumer sector because the Fed was busy printing money and reflating the system, which I think they're going to do again because they've done it every single time before, and it's what every central bank does at the end. Yes, that's true that bail-ins can happen. It happened in Cyprus. It happened in Argentina in 2001. It can happen here. And the nafka, meaning the difference will be in stocks. Are you going to own your mining stocks? And I'm not 100% sure that you will, which is why I also advocate chiefly to own physical gold and silver. Now, what is happening to gold now versus commodities? Gold was breaking through some kind of level, 2150, and now it's at around 2000 again, and people are talking about manipulation. Maybe in a small sense there is. I don't deny that there is manipulation in futures markets. I just don't really care about it that much because the futures market is the manipulation itself and the way I look at things. But if we look at gold versus commodities now, right, this little candle that's sticking up and going past 8, in the gold versus commodities index ratio. So this is the fall from 2150 to now. It hasn't fallen that much. It has not been a very dramatic fall because what's happening in commodities now is that they're all falling. And whether we like to see it that way or not, and we don't like to see it that way because we're gold bugs, gold is money, yes, in a logical sense, but the market treats it as an industrial commodity for jewelry and whatever else. It doesn't see it as a monetary commodity. It doesn't price it as a monetary commodity, at least not fully. And so as commodities fall, gold tends to fall with it, but it falls much less, which is why its purchasing power rises during these deflationary periods. So we have here this line at about 8 in the gold versus commodities ratio. And this was the line it hit in 2016. That was at the end of the gold bear market that ended at the end of 2015. And this is when miners were really zooming up higher. We hit that again in 2019, in the middle of 2019, and we passed it and we tested it one more time just prior to the huge skyrocketing of gold's purchasing power into the 2020 insanity. And look at this, we're back at it again at that number 8, and it tested here, and now we've broken through it briefly here, and we're testing right below it here. I think when we hit this number, we're in danger of a deflationary crash, which I think the Fed will respond to by printing $5-6 trillion, and we will be in the hyperinflationary phase. But if not, and they don't, we will hit a hyperdeflationary phase. And either way, gold's purchasing power and silver's will rocket higher. Silver's much faster because we will be heading towards a 15-to-1 ratio, the end game ratio in gold to silver. The dollar denomination terms really do not matter that much. Now check out what oil is doing now. This was the 2020 bottom when oil hit negative $35, right? You talk about a deflationary crash. That was one of them. And in that deflationary crash, Gold fell to 1450, which was not that extreme, less than 15% from the 1704 top. But the point is here that oil is falling, has closed in a weekly basis below its 200-week moving average for the first time since the 2020 catastrophe insanity. I don't want to talk about what the world was doing there because it's just a bad memory. But you see here that the 200-week moving average in oil was tested 1, 2, 3, 4, 5, 6, maybe 7, 8 times, mostly in 2023, and it tested it again and it broke through. Does this mean that we are at the beginning of what is a developing banking crisis? Well, we'll have to see whether the reverse repos run out in the next few weeks. It could happen, or some kind of crisis in the treasury market. Don't know for sure, but what I'm saying is that hyperinflation and hyperdeflation are the same thing. Gold and silver are the money. Dollar is just a derivative. And so what gold is worth in dollar terms is not really going to matter when the dollar crashes because of hyperdeflation or hyperinflation. Even if there is hyperinflation, they'll lop off 4, 5, 6, whatever, how many zeros, and go back to the 1971 nominal value of $35 an ounce, but the purchasing power of gold will not decline because they lopped off a bunch of zeros. The zeros do not matter. But yes, a concession. What does matter is for gold stock holders. And if the Fed or the federal government or whoever is in charge decides to steal everyone's bank account, if they can get away with that without being lynched, and I'm not calling for any violence, but if they can get away with this, while much of the civilian population is armed in the United States, then yeah, they'll try it, but I don't think they can actually get away with it. It's too dangerous for them. They might get injured. And so it appears if what is happening is deflationary, meaning gold falling from 2150 to what was it, 1980 or whatever it was, I think it was less than 10%, it could be the beginning of a deflationary trough that is developing in the banking system. Something might be happening in the monetary sphere. It will happen eventually, and the Fed will either allow hyperdeflation to happen by confiscating everyone's assets, or they will print and allow hyperinflation to happen, and most people's assets will be confiscated through hyperinflation anyway. It doesn't make a damn bit of difference. Gold is the money. Silver is the money. What we are watching for the endgame ratio is a 15-to-1 gold to silver ratio, and the dollar terms do not matter.
In the unpredictable dance of hyperinflation and hyperdeflation, keep in mind that these precious metals stand as steadfast pillars of stability. Stay watchful, stay informed, and stay connected. Don't forget to like, share, and subscribe to our channel as we navigate the constantly changing financial landscape. Thank you for being part of this enlightening journey, and may your investments consistently sparkle as brightly as the enduring allure of gold and silver. Thanks once more for joining us.